In this video, we're going to go over Chapter 4, looking at financial services and savings plans and things like that. You can see some of the learning objectives, what are some of the commonly used financial services, comparing the different types of institutions, this sort of thing. Now, banking has changed over the years. Many years ago, as I was working my way through school, I worked for a bank. Not on the retail side, in other words, with the tellers and things like that, but in operations. I was running transit, in other words, processing all of the checks and things that went through the system. Now, a lot of mistakes that people make as far as managing their money is overspending. They don't really understand how much they actually have, and they have a tendency to overspend based on things that they want at that point in time. What that causes is insufficient liquid assets, in other words, not enough cash, all right? Or they might borrow to pay some of the current expenses that they may have. And so you have to be careful as far as your spending is concerned to really think about managing your daily money needs. Now, there's different types of financial institutions and things like that. You have your deposit institutions, in other words, commercial banks, savings and loans, what most of us are familiar with. Then you have non-deposit institutions, things like life insurance companies and investment companies who will manage money in various ways. You have other financial services, okay, pawn shops, check cashing outlets, some of the things that we don't necessarily want to use. And then you have your non-bank financial services, okay, your retailers and online banking services and things like this. A lot of times people are saying, okay, I need some cash. Okay, something's happened, I need some quick cash. Well, there's a couple of things you can do. You can take it out of your savings, or you can borrow it. In other words, get a credit card advance. Those tend to be expensive and they reduce net worth, which is why it's so important to make sure that you're managing your money. Now, there's different types of financial services that you can get. You can have savings accounts, payment services, in other words, things where you can pay your bills and things, short-term or long-term borrowing, and then other types of financial services such as insurance, okay, maybe investments. So be thinking about the different types of financial services that you might need. One of the things you may hear about is like a cash management account or an asset management account. Basically what that is a way to get to cash that's run by investment companies. They'll charge you for it, but you can get a little bit better return on some of your money that way. Now, most institutions offer online banking, and I think most of you will probably have some sort of online banking that you might use. I know that a lot of folks are using ATMs and debit cards and things like that. There's also all kinds of e-banks that are out there and this sort of thing. And I would venture to say that a majority of you are using your smartphone, okay, your iPhone, your Samsung, whatever, to do some of your banking. All right, there's some positives to it, and there's also some drawbacks, things like privacy and security and things like that. A lot of times people are using these mobile services for getting cash from ATMs, finding out how much is actually there right now. Can I go buy this thing or not? Instant payment for bills, okay, things like this. You can deposit paychecks, okay, in other words, they'll be electronically put in there, and maybe one of the things you can do is you can actually take a picture of a check and have it deposited to your account. And then there's other services that you can do as far as your mobile banking is concerned. There are some benefits and concerns, all right? It can save you time and inconvenience. You don't have to go someplace. You can just do it right there wherever you're at with your phone. You're not leaving a paper trail for somebody to steal your identity. There are some concerns. Privacy. I mean, accounts can be hacked. Anything that's electronic can be hacked. ATM fees. If you're not using an ATM that belongs to your bank, chances are you're going to be paying a fee for it. Overspending, because you really don't know how much you've kept track of, how much you've actually spent over time. Prepaid debit cards. In other words, gift cards. All right. I think all of us have received gift cards for Christmas or for a birthday or something like that. Major concern with them is fees. It makes it real easy. You get a gift card, you can go buy something with that a Visa card or something like that, and what it does is it goes ahead and takes the cash out of that card. I mean, you put $100 on there, you have $100 to spend. It also results in lower consumer debt, all right, because you've actually paid before, not later. So there's some things to be thinking about as far as your financial planning. Think about your interest rates that are out there, prices maybe going up, could be inflation and things like that. And you can always check various information sources as far as what's happening with the economy, what's happening with interest rates, things like that. Something to think about. When you start thinking about taking loans and playing the spreads as far as what's happening with the economy, if interest rates are rising, what you want to do is you want to take out a long-term loan as soon as you can. You're taking advantage of the lower rates. If interest rates are falling, what you may want to do is use short-term loans if you need money. Just do something short-term because rates are dropping. Later on, you can refinance maybe with a lower rate. And then also look at long-term savings instruments like CDs and things like this to lock in a little bit higher rate. A lot of businesses will offer various financial services that banks used to do before. So some of the things to think about when you're thinking about different financial transactions or institutions, folks, shop around. Shop around. Where can I get the best return on my savings? How can I minimize my costs? Things like this. What you want to do is you want to, this is in the book, in this little table here, list your most important features that you're wanting as far as an account is concerned. What kind of services, what kind of costs do you want to avoid? How convenient do you want things to be? Do they offer online and mobile banking? Rank them, prepare a list of some of the organizations that provide some of those things, and then do some research. Talk to folks who have been using it, look up on the internet what kind of user reviews there are, things like that. So shop around, folks. Now there's different types of institutions. First of all are deposit institutions. So commercial banks and savings and loans. Commercial banks have a tendency to have a wide range of services that they offer. And they are owned by stockholders. Now the same thing with savings and loans. They tend to be owned by stockholders, all right? And they might offer specialized savings loans and plans and things like that. You also have mutual savings banks. Now these are owned by the depositors. They're not owned by corporations, they're owned by depositors. The profits that they have go back to the depositors with a little higher interest rate. You may have heard of credit unions, and some of you may belong to a credit union. Again, those are user owned. And what happens is they have a tendency to have lower fees and lower rates as far as loans are concerned. Now, non-deposit institutions, things like life insurance companies. You can buy a life insurance policy, and we'll talk about this later in the semester, where you're getting pure protection as far as your life or something along those lines, and you could also have what's called a whole life policy where you have an investment portion to it. You have investment companies, things like TD Ameritrade, American Century, things like this, that will manage money and possibly also have various instruments that you can buy. Brokerage firms, credit card companies specialize in short-term loans. Everybody has a credit card. You basically, whenever you use that credit card, you're getting a short-term loan. Finance companies and mortgage companies, again, these are all non-deposit institutions. Now, there are also institutions that do some financial management that aren't quite as helpful, possibly. Pawn shops. One of the things that you might do is go to a pawn shop and you can get a loan. In other words, here's something, let's say a guitar. Here's my guitar, and they'll loan you a certain amount of money for it. And you go back and you pay it back along with a bunch of interest, and you can get it back. Or you can sell that guitar to the pawn shop. You have check cashing outlets. In other words, what they'll do is they'll charge you a fee for cashing your check. If you go overseas or you go to an airport someplace, you'll see there are currency exchanges. That's like a check cashing outlet. They'll charge you a fee, and it's a relatively hefty fee for getting that cash. Then you have payday loan companies. There's some real issues with payday loan companies. In other words, you might need, say, $500. And what you do is you take a payday loan of $500 and you'll pay it off at the end of the month. And with that, you'll pay a fee of $50. All right. So in other words, you're borrowing that And it seems like, okay, $50, 10%, okay, big deal. I'll pay you the $550 at the end of the month. The thing is, on an annualized basis, that is actually 120% interest. So you're paying a heck of a lot of interest as far as payday loan companies are concerned. Rent-to-own centers charge high interest rates also. Car title loans are basically the worst. In other words, you go in, you say, okay, here's my title, and you borrow money against it. And they can really charge some high interest rate up to or exceeding 200%. Now, you can get savings plans, all right? Now, savings accounts are some of the safest ways to go. It makes it easy to get to your money and things like this. The thing is, it's a very low interest rate that they pay. Now, there's also CDs, certificates of deposits. Basically, what you're doing with a certificate of deposit is you have a contract with the bank or whoever is issuing that. You leave money on deposit with them for a certain length of time. Could be 30 days, 60 days, 90 days, something like that. And they will pay you interest on that. Now, there's some caveats to it. A lot of times there's going to be a minimum deposit that's required. And if you withdraw early, there's going to be penalties. And so one of the things to think about is, all right, so I do have some money I want to put aside for short term. Let's say I'm not going to need it for maybe 60 days. I'd like to get some extra interest, earn some extra interest on this over 60 days, more than what I could have done in a savings account. CD is a way to go. One of the things to think about is getting different CDs. In other words, one of the things you can do is maybe have one CD, $2,000 worth, and for 6 months, maybe another $2,000 for 3 months. In other words, what you're doing is you're setting it up so that you've set aside a bunch of money. The thing is, some of it is going to be available to you sooner than some of the other money, depending upon what your needs might be. There are different alternatives as far as the savings accounts, all right, money market accounts, CDs, and bonds. Interest earning checking accounts. In other words, you can get a checking account which will actually pay some interest. There's going to be some caveats to that. The interest is going to be relatively low, and many times they limit the number of checks or withdrawals that you can actually make. Money market accounts. Money market accounts are where you put money into it and they will pay interest on it, but you have to keep a pretty high minimum balance. And what they do is they'll pay the interest on that. The thing is, if you have a money market fund, it is not covered or protected by the FDIC, the Federal Deposit Insurance Company. The safest things that you can buy are savings bonds. Savings bonds are basically where you buy a bond and at half the face value, and it will mature after a certain number of years. These are very safe. Basically what you're doing is you're loaning the federal government money. And there's different types of bonds. You have Series EE, HH, which no longer are sold, I, things like this. Very safe. The thing is, you're tying up your money for a certain length of time, and many times it can be just a little bit at a time. And you'll be able to get it at the end of it. It will continue to draw some interest. One of the things to think about in evaluating savings plans is the rate of return or the yield. And you're trying to balance what kind of return are you getting with the taxes that you will pay, how liquid and how safe is it. These are all things to think about when you start thinking about savings plans. Another thing to think about is compounding, how frequently the account that you're looking at is compounding. If you have something that's paying interest, say a 4% interest rate for the year, all right, at the end of the year, you put $10,000 away, at the end of the year, you're going to have $10,400. However, if it's compounding quarterly, monthly, or daily, what's happening is you're getting interest paid on top of interest. So if you have daily compounding, you actually make $8 more than you would have if it was just annually. And you can see that if you left that in the account and it's compounding daily, there's quite a bit of difference between what you would have had based on the amount of compounding, how often it's being compounded. When you think about savings plans, you have to evaluate certain things. What kind of inflation is going on? What kind of taxes are you going to have to pay? What kind of safety? The FDIC, you put money into like a corporate bank. All right. The FDIC is going to protect that. It's insured by the FDIC up to $250,000 per person per bank. Let's say you have $250,000, you put it in one bank, you have another $250,000, you put it in another bank. Each of those are protected at $250,000. If something happens, you get $500,000 back. You have $500,000, you put it in one bank. If it goes under, you get back only $250,000. These are all things to consider as far as the safety and things like this. Also think about payment methods. All right, more and more people are not using checks to pay for bills. What they're doing is they're doing things electronically, or they're using debit cards, things like this. I pay all of my bills electronically. I very rarely will write a check. Now there are other types of payment methods. All right, you have your debit cards, everybody's familiar with that. You have online payments. In other words, PayPal, a lot of people will do that. Google Wallet, they can pay bills with Google Wallet. And you can also do peer-to-peer payments with Google Wallet. I've done that. Mobile transfers, stored value cards, in other words, the gift cards that we might get. You want to use a credit card if you need to delay payment on something, build your credit history, all right? Buying online, I strongly suggest if you're going to buy something online, use a credit card to do it. You get more protection. Use a debit card to limit your spending and avoid some of the future bills and the interest that you might have to pay. One of the things I suggest to folks, you want to build a credit history. Go get yourself a gasoline card. What you do is you use that to buy your gas. Go to Phillips 66 or something like that. You use that. First month, you pay it all off. Second month, you pay it all off. Third month, carry a balance. Fourth month, pay it all off. This sort of thing. What you're doing there is you're showing you can use a credit card and pay things back. You can be trusted with a loan. Regular checking accounts, you typically have a monthly service charge unless you're carrying a balance. One of the things that I do with my checking account, I keep a balance in there that's high enough where I don't have to pay the $7 a month fee. You have activity accounts. In other words, for every check or for every transaction that you have, they might take out a little bit of a fee. And then you have interest earning accounts. Again, what you want to do is shop around. Look at what kind of things that you're looking for as far as what kind of restrictions are out there. A lot of times you can get a student account that's free. Check what it is that the various banks have. Shop around. What kind of fees and charges they have, or special services. What kind of interest rates are they paying? When you're thinking about these things, think about what kind of restrictions are going to be there. What kind of overdraft protection. So for example, with my accounts, I do have overdraft protection. There's a $500 overdraft protection. If for some reason I bounce a check, I get screwed up on my account, I bounce a check, it will actually take a little loan out of that overdraft protection piece. You also think about other types of checks. A certified check is where you have a personal check with guaranteed payment. You go to the bank and they will certify that those funds are there and they mark it on the check. A cashier's check is one that you go to the bank, you go to the teller, and they will give you a check that has that, and it's verified, it's guaranteed that whoever you give that to, they're going to get that money. You're also going to pay a fee for that. Money orders are like a cashier's check. You can buy them at the post office or something like that. Traveler's checks really aren't used much anymore. So when you want to think about opening a checking account, be thinking about, are you doing this as an individual or are you doing it as a joint account? All right, maybe you're a couple, you're married, things like this. And there's different types of endorsements when you make deposits. When you get a check and you're going to deposit, you sign it on the back with your signature only. That's a blank endorsement. A restrictive endorsement says for deposit only. One of the things that you might want to do is you get a check to protect yourself, make sure you write on there for deposit only, and you put your account number on there and then sign it. That way, if somebody gets that check, they cannot deposit that check. You can also do a special endorsement. In other words, okay, here's my endorsement, you sign it, pay to the order of, and you write in what it is that you want who it is that you want that person to cash that check. Whenever you are managing your checking account, make sure that you are keeping track of everything you've done. Now, it talks about writing checks. All right, when you write out the check, put in the date, who it is you're sending it to, how much the check is, write in the amount of check in words, sign it, and then note the reason for the payment on there. Also, make sure you keep track of it in your records, because you need to reconcile a checking account. All right, so what you're doing is you're comparing what is it that I've actually done to what is it that the bank says I've done. What kind of deposits have been in there that have not been logged into as far as the account is concerned. Take out any fees that you might have, add in any kind of interest that you might have. Make sure that what you say that you have in your records matches what the bank says it has in his records. So as far as the summary is concerned, there's all kinds of different products as far as plans and checking accounts and loans and things like that. There's all kinds of organizations, commercial banks, savings and loans, investment companies that will manage money. Some of the commonly used savings plans, regular accounts, CDs, things like this. Shop around, folks. Find what it is that you need that matches your needs. If you have questions, give me a shout.